Not a single time in my lifetime has this ever occurred. A Fed rate decision that has been unprecedented. Also, 4 actions by the SEC explained. All of this in one video about the stocks that you guys care about. Because you likely came here because you're wondering, what exactly is the Fed rate decision? 75 bips. 0.75% interest rate bump, the most since 1994, have to do with the incoming squeeze, and exactly this, what does it have to do with us destroying that like button on the way in. Thank you guys for coming into this video. Make sure you guys watch until the end. My name is Andrew, and yeah, I'm a 27-year-old data scientist that has never seen this much interest rate rip in order to slow inflation. The Federal Reserve on Wednesday raised interest rates by 0.75%, the largest move it has made in a single meeting since 1994. This is a good time if you guys wanted to comment out which like you guys are down below. It's a pretty good time to make sure you guys are getting up to 1200. The central bank messaged that further interest rate hikes will come this year as the Fed leans on higher borrowing costs to dampen demand and work to slow faster than expected inflation. Overall economic activity appears to have picked up after edging down in the first quarter, the policy-setting Federal Open Market Committee said in a statement, repeating its commitment to ongoing increases. The Fed decision lifts short-term borrowing costs to a target range between 1.5% and 1.75%. Here are the federal funds target rate over the last 50 years. Here's the x-axis here. Look at that, 1970 over in 2020. So there's that catastrophe right here, right around the early 1980s, and now on a downward slope that we have not seen a similar rip since 1994. In economic projections released Wednesday, the median Fed policymaker expects to further raise interest rates roughly to 3.5% by the end of the year. That would suggest another 1.75% in total rate hikes spread across the remaining 4 scheduled policy-setting meetings this year. The Fed is now messaging a much steeper path of rate hikes than it had previously forecast in March. So, if you guys missed all of that, it essentially means that inflation is going crazy, the dollar is starting to get devalued, which means that we now need to make it harder for people to get their hands on cold, hard cash that they did not earn, but they borrow. In that sense, it means that it's going to cost more in order to keep things on borrow, right? And that is fantastic for FTDs, failure to delivers, that then cycle in and become a brand new borrow. And some of these borrowings, right, are of naked stocks, something that we've talked about a lot on this channel. Make sure you guys have already hit that subscribe button to make sure you don't miss out another analysis of it. It essentially puts the gaslight into the system that already has a ton of fire. We are looking at whether or not there is going to be an opportunity for shorts to turn this around by trying their best. We've talked about the different seasonal changes of the T+1, T+2 in the last analysis, but that is something that then we are now going to see shorts either panic or we're going to see the shorts ease up. This urgency to move fast coincided with Fed policymakers' expectations that inflation will not abate as fast as they expected in their March projections. The median Fed policymaker now expects prices to rise 5.2% as measured by personal consumption expenditures, PCE, over the course of 2022, a faster pace than 4.3% it had forecast in March. The central bank had downgraded expectations on other key economic measures, expecting the U.S. economy to grow by only 1.7% this year, compared to the 2.8% it had forecast in March. The Fed officials also suggested that they could see unemployment rise this year, with the median number now forecasting a 3.7% headline unemployment rate by the end of the year, which would be a notch up from the 3.6% recorded in May. The decision to raise interest rates by 0.75% was an abrupt turn from last week, when markets had already expected the central bank to follow through on its communicated strategy of raising it 0.5%. But a hot inflation report on Friday showed the fastest pace of price increases since 1981 showed little sign of alleviating price pressures in the month of May, combined with other economic data showing the worst reading of consumer confidence since the 1970s. The pessimistic outlook pushed the Fed to entertain the idea of abandoning its prior plan, which we know they did. The decision to raise rates by 0.75% on Wednesday was not unanimously agreed. The Kansas City Fed President Esther George dissented, with the statement noting that she favored 0.5%. The Fed's economic projections suggest a confidence among policymakers that a more aggressive rate hike path will cool inflation. Although the central bankers raised their expectations on inflation for 2022, the median number of the committee expects to see the pace of headline price increases to cool to 2.6% next year. These forecasts suggest inflation could further in 2024 to 2.2%, much closer to the Fed's 2% target. Next FOMC is going to take place in the last week of July. So I will be streaming that. Make sure that you guys have already commented down below which comment you are. But if you guys haven't yet put a comment down, make sure you comment out that you got to this part of the video. I'll select a couple of you guys. Just answer the question, what do you guys think Meatball's favorite activity on a Sunday afternoon is? And I will select some of you to have a better understanding of the financial freedom that you guys are. It's easily out there for every single person to achieve. 4 actions by the SEC explain PFOF, fees, meme stocks, and UST. So, you guys probably know about the ban on payment for order flow. This is something that we've commented out on this channel a ton. And what could be the biggest shakeup of the US equity market rules, the US Securities and Exchange Commission is considering a total ban on the PFOF practice, which has been growing in recent years to the detriment of small firms and other mom and pop investors. Payment for order flow, which is when the market makers pay brokers to execute their clients' orders, is already banned in Canada, the UK, and Australia. A formal proposal will likely be filed in fall. SEC Chair Gary Gensler said the ban is not off the table, noting that PFOF exists with inherent conflicts. These are conflicts of interest, of course. In December 2020, PFOF also put Robinhood markets in a tight spot after it ordered to pay a fine when the practice raised costs for investors during using the online brokerage. Number 2, information disclosure, also part of the potential changes. The SEC intends to make it mandatory for market makers to disclose more information regarding the fees that the firms earn and the timing of trades. In considering the changes, Gensler said that he asked staff to take a holistic cross-market view of how we would update our rules and drive greater efficiencies in our equity markets, particularly for retail investors. We actually go into this into a lot more detail in the last 2 videos, so make sure that you guys check out the ones about the SEC, especially the one that I'm going to link in the right up there for you guys. If you guys haven't checked that out yet, that is a ton of detail on what the SEC is trying to do. Fundamentally, the potential changes that would change the business model of wholesalers and impact brokers' ability to offer commission-free trading to retail investors. Number 3, SEC on meme stocks. PFOF was put on the spotlight in 2021 when a group of retail investors went on a buying spree of meme stocks like GameStop and AMC, squeezing hedge funds that had shorted the shares. Recognizing the dangers of these meme stocks, the regulator recently released a 30-second game show-themed public service campaign against investing in these assets amid their growing popularity, particularly among retail investors. We've also commented out on this. We even have a video about exactly my reaction to that this public service campaign. The video ad titled Meme Stocks is part of the Commission's series of public service videos called Investomania, and is aimed at helping investors make informed investment decisions and avoid fraud. The series previously warned against the dangers of investing in crypto assets, margin calls, and guaranteed returns. Despite the good intention of the campaign, it sparked an outcry from Redditors, particularly to Wall Street Bets, where users discussed the next stock to pump up. One user said the SEC did not offer warnings before the 2008 crash, the dot-com bubble, and the 1980s recession. So why warn about meme stocks? The release about SEC's campaign against meme stocks came a year after the commission said that it is observing markets for signs of any disruptions, manipulative trading, and or other misconduct. So, you guys have already been up to date on 1, 2, 3, but here is number 4, regulation in action. In another exercise of the SEC's regulatory powers, the watchdog was reported as also looking into potential violations that may have resulted in the collapse in May of the Terra USD stablecoin. Bloomberg News, citing a person familiar with the matter, reported on June 10th that the regulator's enforcement attorneys are investigating whether Terraform Lab, the firm behind the coin, also known as UST, breached federal investor protection rules in how it marketed the coin, which was supposed to keep a one-to-one peg to the US dollar through an algorithm and trading in a related token called Luna. Unlike other stablecoins, UST relied on an algorithm, not a central issuer, to maintain its peg. If a probe is indeed pursued, this will be not the first time Terraform Labs will be summoned by the regulator. The SEC has ordered the company's CEO, Do Kwon, to turn over documents and provide testimonies regarding the Mirror protocol, which is a non-custodial trading platform used for trading mirrored assets or massets that are meant to be synthetic versions of stocks like Tesla and Apple. Huang filed an appeal against the subpoena but was overruled on June 8th by U.S. District Court of Appeals. So there you have it. I hope you guys understand that this is a big upset in the world of the normal stock market, the big players. But in the sense that things are more expensive to borrow, this is something that can reverberate and continue our watch of the margin call squeeze already in action. Thank you for those of you who have made this show possible. Thank you for those of you who watched until the end, especially you listening right now. Thank you for joining the Moon Platoon. And if you guys wanted to also join the Moon Platoon on Twitter and Instagram, I give away stuff all the time there. So make sure that you guys have already followed on both to be eligible. Follow the second channel. It's for cool people only, but I think you guys are eligible. And finally, hit that subscribe and the notification button and that join button if you want to be on one of these end screens in the near future. Thank you guys, and we'll see you guys in the money. Peace.